Hi, my name is Monika Hengesbach. I'm an enrolled agent, certified tax preparer, and owner of Decision Financial Services, and I'd like to welcome you to the Wealthy Wallet. For those of you that were able to watch the podcast episode or listen to the podcast episode a couple of weeks ago, I gave a lot of tips and strategies on real estate investing, how to save money on your taxes when it came to capital gains, or some of the pitfalls of owning real estate as an investment. And I figured the best way to sort of follow that up was to have an expert on this podcast in the banking world to discuss how you can get through the process of getting that loan to acquire either your first investment property or your 100th investment property. So I am very privileged to have Sharon Sherley-Mylius here. She's the branch president of Worthington Bank located in Colleyville. So thank you so much for being here. So Sharon, tell us a little bit about how long you've been in banking and what your role is at Worthington.
Absolutely. Well, I have been at Worthington about a year and a half, but I have been in banking for 33 years. I've always been in the Northeast Tarrant market, and the last 17, 18 years, I've been in Colleyville specifically. And so the role that I have at Worthington is pretty much the role that I've had at my previous employers. And so I am a market president, so I'm responsible for my market, but my primary job function is lending. So I've always been a lending officer. I do focus a lot on real estate, commercial real estate. I don't do things like house loans and car loans and things like that. We have other people within the bank that do that. Mm-hmm. But that's always been my bread and butter is real estate. And in particular, real estate investor loans. We have done a lot of those. And I hope that I'll be able to share some really good information with people. And I appreciate being here.
Wonderful. Thank you. Well, tell me, what types of investment properties do you specialize in financing?
Really, one is about the same as any other, with the exception. The only thing that has, well, there's two that kind of have some different caveats, and that would be a multifamily apartment complex mm-hmm. or a high-rise building. So those are kind of specialized. I've done each, but we don't tend to do a whole lot of those. There are other lenders, because those transactions tend to be very large, that really only do those things, and they're more your institutional lenders. Sure. So what we normally see is I do a lot of retail and office, owner-occupied and non-owner-occupied, so I do both of those. And then also we do some residential. So the people that you see, the house flippers, or the people that are trying to build an investment portfolio, in particular, lots of times self-employed people will build an investment real estate portfolio as a means of a retirement income stream. And so those are sort of the things that I tend to focus on, but we can do the other things as well.
Okay. Now, are there specific loan products that are geared more towards real estate investors?
Absolutely. And I think that was one of the questions that you sent me, and it really depends on what their end game is. So you may have the investor that wants to acquire properties, improve them, and resell them for a profit. And so if that is the case, then I'm going to structure a loan for a shorter period of time, and it will have payments of interest only. So you won't immediately go into what you think of as a conventional mortgage payment, because you don't have the means to repay it until you sell that property. So the interest is figured in as part of the cost of improving that property when you calculate all your costs. And it's generally for 6 months or 12 months at a time.
Okay.
If you're going to acquire a property and you're going to hold it long term, and it's going to be what we call an income property, which means you would rent it out and have a steady stream of income coming in, then I would structure that financing accordingly. So in my world, that kind of financing depends so much on cash flow. So we would look and see what the cash flow was or is anticipated to be, and we would make sure that, very simply put, the property can generate enough income to pay the loan payment, can pay the property taxes, and can pay the insurance, if those things are part of their equation.
Sure.
And so that's how that is. Now, I'm a commercial bank, so I don't have a 10-year, 20-year, 30-year fixed rate mortgage. And I know we'll get into a little bit farther the different types of loans that there are and who does what and where and when and how. But normally in my world, what you're going to see is you're going to have a loan where a payment is based on a longer period of time or amortization, and your maturity date or your rate adjustment date is going to be shorter. So a very typical structure for investment real estate is to do a loan that has a 20-year amortization. That's what your payment's calculated on, but it all comes due in 5 years. So there will be a balance at the end of that 5 years. And that sometimes scares people a little bit because there was a time when banks were very, very fond of calling notes due at maturity. That really very rarely happens anymore. And so what that 5-year period gives you is the opportunity to refinance, renegotiate your terms, or do something else with the property. You're not expected to repay the entire thing in 5 years.
Sure.
So those are really the two different things that I offer.
Okay. You touched on it a little bit. One of the biggest questions that I get asked in my practice in regards to clients wanting to acquire more rental properties is the fact that how is that calculated? Because here they're feeling, well, look, I'm getting all this rent in and it's covering my principal, my interest, and all the costs associated with it, but my bank turned me down for a loan. How is that calculated for real estate investors or people that want to get into rental property? How is that rental income calculated as to how much they can borrow?
Absolutely. That's a great question. So where most people are going to be familiar with the debt to income ratio.
Yes.
That's a very standard term in conventional mortgage underwriting. And really simply, it just takes all of your income sources and, CPA, you have your W-2, you have your Schedule E, your Schedule C, all of those great things, allows for taxes, and then says, what are your monthly debt payments? That's the debt to income on the consumer world. In the commercial world, in particular, if it's a real estate investor, we will take the income generated from all the properties. We will give an allowance for some vacancy. So we will take that out of the total that's available because at any given time, there's probably going to be some vacancy. We usually use 10% to 20% just to kind of see what that looks like. And then that gives us what the net rental income is that's available to service the debt. We then take that, we add all of the debt payments, all right? So anything that may be out there, we're going to look at. So all the properties that have a mortgage associated with them, we will take that number, and then all the property taxes and all the insurance. We also will take an allowance for repairs because a lot of times people don't think about that. So all of those are factors. So there's a few more things in there. It's not just as simple as income to your loan payments when you're talking about commercial.
Okay, that makes sense. So tell me a little bit about the loan process. I love it because everyone wants something yesterday. Yes. But, what exactly can speed up the loan process, and typically how long does that process take?
Well, the number one thing that can speed it up is being prepared. Just like when you have to take your information to your CPA to prepare your tax returns or your financial statements, the more information that you have together and the less that they have to hunt for or request later, it's going to speed it up. So I'll take you through two transactions. So I'll take you through just a person that's acquiring a piece of property, either for sale or for holding. All right. We'll just talk about one single piece of property. So the first thing that I will need, let's say that it's a company. All right. I will need their past 3 years tax returns if they exist. And then I will also need their past 3 years internal financial statements. So whether they use QuickBooks, whether it's something you prepare, I will still need those. People always say, why do you need both? Well, I need both to compare. And because in some industries, as you know, the tax return is going to be different from your internal financial statement depending on what kind of tax accounting that you employ. So these are all things that I will need. If it's in the middle of the year, I'm also going to need an interim financial statement, balance sheet and income on the business. So let's say if you made application right now, I would love to get the end of March. I probably won't, but I would love to get the end of March. So those are the two big keys. All right. I also need to get a personal financial statement. I get this question a lot. Personal financial statement is simply a statement of your assets and your liabilities. And your assets are everything that you own, and your liabilities are everything that you owe. And it's put together in a consolidated format that I can interpret. Now, there are lots and lots of forms out there, but the banks usually have one. I mean, I have one that is an Excel format, and you just input the information and it creates it for you. There are super simple versions. The SBA is a great resource. They've got tons of forms and files and things that you can do this to. Or if you use QuickBooks, Rocket Money, several of the different personal financial accounting software and platforms, it will generate a personal financial statement for you. And then I also need the individual's last 3 years' tax returns. So those are things I'm going to need no matter what. In addition, if you've made an offer, you have a contract pending on a piece of property, I'll need a copy of that. And that's sort of what starts it ticking.
Okay.
The approval process, let me circle back. So that's for an individual, all right? So let's say we have a company that this is what they do. They have investment properties. I'm going to need the same amount of information, all right? I'll need 3 years tax returns, 3 years financial statements, an interim statement if it exists, personal financial statement, 3 years personal tax returns. But in addition, if it's a company that has multiple properties, I'm going to need a rent roll. And what a rent roll is it's a list of all the properties, the name of the tenant, or something that will indicate who it is. You don't have to be too specific. But then I need to know the date that the lease started, the rate of the lease, the date the lease expires, and then also the terms of the lease. If it is commercial and not just residential, then I'm probably going to want to get copies of those leases as well. Okay. So those are kind of the two packages of information that I would need. And if you're acquiring a property, a copy of the contract and or contracts.
Okay.
Now, I'll give you a little tip on contracts. And I always give these to folks. And it is tough in this market. I know we're going to talk about being able to acquire a property, but I want to explain. If you make a cash offer on a property and you write the contract as if it were a cash offer, if you don't close that property, no matter how, you are subject to losing your earnest money. And those amounts have gotten really, really big. When I started in this business, $500 earnest money was kind of the norm. It was just sort of a token of, I'm going to make good at some point. Now I see earnest money 5, 10, 15% of the price of the property.
Wow.
So it's significant.
Yeah.
So when you write a contract or make an offer, be sure that you put in there it's subject to third-party financing. Then that way you can bring it to the bank. If it doesn't come together, I can decline it and you will likely get your earnest money back. Okay. This is a big deal. And people, especially if you're not that experienced or you're dealing with a real estate agent that's not that experienced, they will advise you to make a cash offer to get your offer accepted over someone who is making an offer contingent on financing.
Right.
But it's a big key. Now, I'll come back in just a second because I just thought of something else that can be helpful. So, all right, I just told you this is the information that we need. These are the kind of structures that we do. But sometimes, and this is really for the more experienced investor, we can set up a line of credit that will enable you to make cash offers. Now, there's a key.
Yeah.
You have to have something to secure that. So a lot of my people that do investment loans full time, they have a portfolio of properties that don't have any loans on them. And so I'll set them up a line of credit that's secured by the property that does not have any loans against it. And then that way they can access that quickly. And make a cash offer, and then we can figure out how we're going to structure it on the other side.
Sure. Okay.
It's a great thing. It's really a great thing for real, especially in this environment, to let people make cash offers.
Yeah.
But again, don't do it unless you really can pay cash in some way, shape, form, or fashion, because it's a big, big pitfall.
Okay.
The process depends on the amount. Every lending institution has different approval processes. So up to a certain amount, it will generally just be one person. In excess of a certain amount, it will be one or two people. And then once you exceed, generally, like in our case at my bank, once you're over $1.5 million total, it goes to a committee. And then just up from there. So those processes, of course, if one person approves it, it's really, really fast.
Right.
Two people, still really fast. In our organization at Worthington, our committee meets every single week. And anytime that we exceed 10 million, it goes to another level of approval, but they're very responsive. And so generally speaking, if you get me everything I need, I can get your approval very quickly. Okay. 2 weeks at the outside. And that's for something that's very large and complex that I have to do a lot of underwriting.
That's great.
On.
Yeah. That's great. That's fast.
But normally it's, a week or less, I would say.
Okay.
This is also a big thing, all right? Be very cognizant when you're making offers of what you commit to as a closing date. Because in this day and age, and it's gotten better, all right? But we can approve your loan, but I still have to wait on other people and other companies. So I have to wait on the title company to get me a title commitment. And it just depends on their work schedule and what they've got in front of you. I have to wait on the appraiser to get me a value for the property. And again, it just depends on their work schedule and what's in front of you. Sometimes I have to wait for environmental reports. So there are all these things in a real estate transaction that are out of my control.
Right.
So I tell everyone 30-day close. If it's a commercial property, it's pretty standard to see 45 to 60 because normally the commercial people know it's going to be slower, but residential, and it's calmed down some now, but I literally had people that were saying, if you can't close this in 10 days, we will not even accept your offer.
Oh, wow.
Yeah. So it's really important. So that kind of gives you an idea of the whole process.
Thank you.
Yes.
Thank you. That was great. You mentioned you hit on SBA loans.
Yes.
When is it better to do an SBA loan versus conventional lending?
Well, it decides for you, right? An SBA loan can only be used for owner-occupied real estate. Now, you can occupy a portion of it. So let's say you find this great office building and you have a tenant. If you are going to occupy 51% of that building, you can do an SBA loan. Okay. If you're building something, you have to occupy 66 and 2/3%.
2/3.
Yes.
So, you measure that perfectly to get that 2/3
really
in there.
It's really funny because, sometimes they're pickier than others. But when, you can't do it for investor loans. There is not a product there. I know that there are workshops out there that are telling these people that as a real estate investor, you can do an SBA line of credit. You cannot. It does not exist. All right. There are a couple of hybrid lines that work if you are a contractor only, but it will not let you acquire and rehabilitate residential property.
Got it.
So I've had that question a lot because it was sort of making that circuit of, come to my seminar. I'll teach you how to be financially independent and you don't have to put any money down. All of those things are just absolutely incorrect. So, but the SBA tells you when you need to use an SBA loan for two reasons. The first reason is the amount of down payment. So in an SBA transaction, I can have as little as 10% down. In a conventional transaction, I'm going to need at least 20. Sometimes more, depending on what. So if it's something that's unusual, like an ice skating rink or a storage warehouses have kind of crossed over, but anything that's unusual,
Right.
a funeral home, trying to think of more, we call them special use facilities, but it can only be used for that one thing. Restaurants, another
Right.
example. I may have to have more money down, but with SBA, 10%, I can usually do those. The second thing is the ability of the business to cash flow. And an SBA lets you go out to 25 years.
Oh, I see.
Commercial real estate never goes out past 20. And so sometimes that can make a difference. And those are really the two primary reasons that I use SBA. I don't go to SBA automatically. It's just a product that I've done for a lot of years, and it can be very effective when it's used in the right way.
Okay. But SBA loans usually take longer to process.
Not necessarily.
A lot more red tape, no?
Not necessarily. So there are two types of SBA lenders, all right?
Okay.
Well, there's three. There's one in the middle that doesn't get used anymore. But basically, there's just a regular SBA lender, which means they've been approved, and there's a preferred SBA lender.
Okay.
A regular SBA lender can participate in the program, but the SBA has to underwrite the package. You never know how long that's going to take. I've had really good experience. My most recent employer was not a preferred lender, and I had really, really good experience. So I was getting about a 3-week turnaround.
Oh, wow.
That's because I know the product, I know the program, I know the system, I know everything I have to have, but it wasn't too bad. Worthington's a preferred lender. So that means the SBA has said, Worthington, you can make this loan without any input from us. So then it's just a little bit extra time to draw documents. So we're still talking about that same 2 to 4 week window there. So
great.
it's not as bad. Now there are a couple of other programs. I'm just talking about their big one in general. There are a couple of specialized programs that could take a little bit longer.
Sure.
But in general, that gives you the idea.
Okay.
But no, the SBA product is only as good as your bank and lender.
Okay. Perfect. So I have clients that have come in, and of course, they've done the famous research of, Google, and now I'm sure AI is going to be their encyclopedia of knowledge, right? But they have many rental properties under their belt, and they're getting turned down because of what you previously talked about by taking everything together. And so they're hearing these things, that there are loan packages that will take into consideration all of the properties, all the debt, and refinance it into one big one. So all the equity can be used to qualify for additional lending.
It's theoretically possible.
Okay.
It's technically probably improbable. And the reason being is, in a real estate transaction, when you have multiple properties, if you are to sell one of those properties, untangling that from a large note is not the easiest thing to do. And banks tend to not want to do that because, and it's bad for the borrower too, because let's say, for instance, we take all the properties and we put them all together in one loan, and they sell the property let's say they sell a property for $100,000, but they sell it for $250,000. Okay. Mm-hmm. And they only owe $100,000 theoretically. Well, the bank isn't going to want to let that go because they've lent against that equity. So they're going to want that entire $250,000 to be paid towards the debt, which is good for the borrower,
right,
where they pay less interest, but it's bad for the borrower because it impacts their cash.
Sure.
So that's the number one reason that I say it's I don't recommend doing that.
Okay.
It's just not that clean, and there's a lot of room for interpretation and misunderstanding. And honestly, the bank is not going to let go of anything that it doesn't have to. That's just our nature. Sure. We are not in the risk business. We are in the risk prevention business.
Right.
And it just kind of could create a lot of hardships, I think, down the line. Now, in that scenario where they have a lot of real estate that has a lot of equity, the ability to pledge that equity to other loans does exist. So if you have a property that's worth $100,000 and you owe $10,000 on it, you can pledge that equity to another loan.
Okay.
So you don't have to do anything. You don't have to borrow any money. But again, if you sell that $10,000 balance loan for $150,000, the bank's going to want those proceeds to be applied to the debt. Okay. But yes, it can be done. It's probably not the best structure for the borrower. No.
Okay. Perfect. And my podcast, I spoke about 1031 exchanges for the fact that it's very beneficial for some of my clients to be able, instead of selling it and paying very large capital gains tax as well as depreciation recaptures, to do 1031 exchange because their goal is to continue to own more real estate. Can you talk about the 1031 exchange process a little bit?
I can talk about it from my perspective.
Yes.
So from the bank's perspective, we have no involvement in that. And people always think I do, all right? But there are groups that do nothing but a 1031 exchange. It generally makes sense only on larger transactions because of the cost. If you sell a property that for $100,000 and you're going to have to pay taxes on $20,000, it doesn't make sense because there's a great deal. Setting up a 1031 exchange is a pretty complicated process. And you have to deal with someone that understands the process because there are really, really strict rules. I've seen a lot less of this because when you have a 1031 exchange, that means you sell a piece of property. So let's say you sell an office building. You have 45 days to say, I have identified this other office building. In normal times, that's not a big deal. In times like right now, you may very well not be able to do that because there's not something that's available that quickly. Then you have 6 months within that time frame to close it. And again, I've had clients that have identified and not gotten it, identified and not gotten it, and identified and not gotten it. Well, the 6 months doesn't start all over. And so if you miss out on a couple of properties, then you're getting into that, little danger zone there. So it's a whole lot more difficult to actually make happen than it used to be. Sure. But again, if it's a large transaction and you're looking at a significant gain, that's why I always tell my clients, the first call you need to make is to your CPA. Call Monika and ask her, does this qualify for 1031? But again, just the normal real estate investor, it doesn't make a lot of sense.
Sure.
But it's a great product. But in this environment, with taxes doing who knows what, they're probably not going to go down. And you sort of have to look at your strategy as an investor. How long are you going to hold it? At what point would you have to realize that actual gain and pay that tax? You may be better off to just bite the bullet and do it.
Right.
And that's another weird conversation. I never had that conversation with people 10 years ago. I just said, okay, let's do it. Great. Let's not pay the government till later. But I've had some pretty large clients that really, they are electing to pay the tax now instead of taking the risk in the future.
Because it's still, there's some rumor on the mill that they're reassessing corporate taxes.
They always are.
So Lord knows what we're going to be doing. The other question that I have is in regards to LLCs.
Yes.
We all know that's an extremely popular structure for holding real estate investment property because it's limitedly liable to what it holds. But a lot of times clients can't get the property or the loan immediately into the LLC. Can you talk a little bit about that?
Absolutely. That was a great question. And I made sure I was right on this, but I thought, okay, I know this answer, but I'm going to double check. So called my mortgage banker friend and said, verify me on this to make sure that I'm correct. So it is strictly when you're talking about secondary market mortgage financing. What that means, you didn't come to Worthington Bank, all right? You went to a mortgage company. The mortgage company's taken your application, and these loans that you go to a mortgage company to get a 15, 20, 25, or 30-year fixed rate loan has to be underwritten by either Freddie Mac or Fannie Mae, our two largest governmental underwriting agencies, all right?
Okay.
Freddie Mac and Fannie Mae loans only allow a person to finance a property that is secondary market eligible, A, if it's in the individual's name, and B, if the individual or related entities do not own more than 10 properties. Those are the rules. There is no getting around those. If you want to get a 30-year fixed rate mortgage, 10 loans is all you're going to be able to do through Freddie or Fannie. That's when people come to me. It doesn't matter to me. I don't care what name the property is in. I don't care. I don't sell my loans in the secondary, so I don't have to underwrite to Freddie and Fannie standards.
Okay.
So you can put it in an LLC. You can put it in the name of your grandchild. I don't care whose name the property is in, as long as my borrower is my borrower. So that's it. Now, there's another really popular thing circulating the internet that says, okay, buy the loan, get it in your individual name, and then just transfer the property to your LLC. Sounds great, doesn't it? Well, because when people close real estate transactions, they do not read all the documents. I don't blame them. I wouldn't read it either. I have to because that's my job and I know what it says. But within the instrument that you sign at every transaction that has a loan on it is an instrument called a deed of trust. That gives your interest in the property to your lender, all right? Secures your loan. Filed of record with the county. It's on record. Everyone knows that the bank has an interest in this property. Within that property is a clause, and it is called the due on sale, DUE on sale clause. It says, if the title of this property is transferred in any way without our express written permission, your loan is in default. And I have seen that employed, not in Texas, but there was a large case in California where, again, these people had, all these rentals and somebody told them to transfer them all to the LLC and they were in violation and the loan was in default and the lender posted all of them for foreclosure within their rights.
Right.
So doesn't mean they're going to get your property back, but it can be very expensive. Just don't do it. Now, you can ask your lender, is it okay if I transfer these properties out of my name and into my LLC? You may or may not. It depends on who ends up servicing your loan.
Sure.
So if it's Wells Fargo, probably not.
Right.
There's no incentive for the bank to do that at all. But if you come to a community bank, a local bank like Worthington, then there's not a limit. We don't have the 10. We don't have any of that. We don't sell the loans on the secondary. And so that goes out the window. But that's why. And that's nobody explains that to people.
No.
And I get so frustrated within my industry that people don't explain that, because if you just explain that to people, they would say, okay, I understand. And it would make sense. Then you would look at your hold properties and identify the 10 that you really want to keep for a long time and do a 30-year mortgage.
Yes.
Make it make sense.
Yes.
So it's just part of your planning as you're building your real estate portfolio to see, what's personal, what's LLC, how do I deploy this and all that. And that's where you come in. Once again, call your CPA.
Well, there's something I like to add that isn't ever expressed. The problem is the minute that they transfer it from their personal name into an LLC, they just generated a sale.
They sure did.
And they may not have sold it, but the IRS code states explicitly that you have to use fair market values in that sale. So they're going to pay an unnecessarily capital gains tax just because they transferred or sold it from themselves into their LLC. And then vice versa, when they refinance that property and they refinance it out of the LLC into their personal name because it's not a business loan, then they constitute another sale and they pay capital gains tax on it again. Wow. And so it's something that does not make sense all around.
All around.
Yep.
All around.
Yep. So now I'm going to throw the $1 million question at you, and it's going to be interest rates. As we all know, this is like the sore subject amongst all of us.
It is.
Can you tell me a little bit about what the going interest rate is, and are we ever going to see lower interest rates?
All right. Well, I will start this. I have young people that I work with me and for me, and I work with our young lenders at different locations. And so, first of all, none of them have ever, think about this, kids that are in their 20s and 30s have never seen a bad economy. They don't know what that is. These young lenders have also never seen normal interest rates. So they're kind of in tune with, well, a mortgage should be at 3%, and I should be able to, get a credit card at 6%, and my car rate should be 0 and things like that. We had very artificial rates for a very, very long time, and it became our norm. So that's my little speech that I'm going to give. I get rate question a lot too. So I'll give you the big view, and then I'll give you the down to it view. The Federal Reserve controls short-term interest rates. That's it. Okay. Everything else the market controls. So when you hear that the Fed's going to lower rates, okay, it doesn't directly impact things like mortgage rates. It doesn't directly impact things that are longer term in nature. It generally has an effect, but it's not the same mechanism to create that. So if you hear that the Fed is going to reduce a rate, it doesn't necessarily mean mortgage rates are going to go down. It means that your rate that you're getting paid on your money market account, your CD, is going to go down.
Of course.
If you're borrowing commercially from a commercial bank, your rate's going to go down because we price on short term if it's floating, all right, or our overall pricing. We price based off those short term rates.
Sure.
Mortgage rates are priced off of longer term rates, primarily off of U.S. Treasuries. U.S. Treasuries are a commodity, so they're traded every single day. So depending on what the outlook is of the market can impact how those Treasury rates go. Normally they kind of trend, all right? So that's like a big, big answer. But the real answer is I have no idea where rates are going. Mortgage rates right now, and I looked before I left just so I'd know, are running in the 6s to 7s. That is not a bad rate.
Right.
The terrible thing, and this is something that I've seen in this market, 6 or 7% is a fair rate, all right, for a mortgage loan. For a 30-year commitment, I mean, think about that. That's pretty inexpensive. But when you take the rate compared with the increase in market values, it really prices homeowners and investors out of this market because it doesn't make sense to pay a higher rate. And it really changes the dynamics, especially investors, when they're looking at a project. Because you could take that same money and deploy it somewhere else and earn a better return if you're having to pay 7, 8, 9% interest.
Yeah.
Which is what you'll pay to a commercial bank when you are borrowing either short-term or that 5-year fixed rate that I talked to you about. It's going to be in the 8% ranges just because that's how we price.
Sure.
And our prime rate right now, which is the average lending rate of the 10 largest banks in the United States, Wall Street Journal Prime, that's how it's determined, is 8.5%.
Oh, okay.
Yeah.
Okay.
So,
now, when would someone go and use a variable rate versus a fixed rate?
Well, if you kind of hedge a little bit, generally you can negotiate a variable rate that's going to be better because, especially like right now, all right? So if I'm going to quote you a variable rate, it's going to be better than a fixed rate because I look at 5 years and, I say, I have no idea what it's going to look like kind of thing.
Yeah.
So you can sometimes, and also the duration of your project, all right? So if you've got a project and you're only going to be in it for 12 months or less, do the floating rate.
Right.
I mean, especially right now, we think that the Fed's going to reduce rates. So it's likely that the rate would go down over the life of your project and save you money.
Right.
So that's really it. But it's very, very common in commercial real estate or conventional that you do a floating rate, not a fixed rate.
Okay.
So.
Perfect. Is there anything else that you would like to add that maybe I didn't ask that you would think it would be very important for first-time real estate investors, even seasoned real estate investors, what they should look out for?
We talked about the market and really understand what you're buying. Really, really understand what you're buying and understand what those returns are going to look like, whether you're going to resell it or whether you're going to rent it, because the prices have gone up so much. People used to really do well in investor real estate when they could purchase a property below market, make improvements, and then get a return based on that improved property. There are no below market deals anymore. There just aren't. If there are, you have to get very far out of the metro area to do it. And everyone is flooding this market. So because Texas is a great state to do business in, because we don't have state income taxes, because there are a whole lot of other incentives that are very, very desirable for businesses, you have professional real estate companies that have come into this market and are acquiring hundreds of residential units, hundreds of multifamily units, because they deploy their capital here and get a better return than in more expensive markets. And so that's probably number one, especially for the person that wants to get in and try one. Just be very, very cautious, and this is a word I always give. Always remember, before you start this process, call your CPA, call your banker, and if you've done any number of these, you better have a good attorney, all right? So call those three people, all right? Let those three people influence your decision, not your real estate agent, because your real estate agent is going to get paid if you close. We're not. I mean, I don't care whether you close or not. I get paid the same at the end of the day, same as you.
Right.
You're going to get paid the same at the end of the day, and your attorney is the same way. And we get paid to look out for your best interest, all right? And that's it. And it's really tough, and especially if you're not seasoned, you get so emotionally vested. I mean, I just went through this with some of my kids, buying a house. And, I'm a real estate person. Right. So, we would walk in somewhere and I'd go, okay, yeah, this is it. All right, forget it. Let's go next. And, my kids, every single house they walk in, they're like, I love this house so much. This is the most beautiful house. I'm going to die if I don't get this house. And people can do that. You can get emotionally vested in a property. And you can really get emotionally invested in a property if you've been watching like home improvement shows.
Oh, gosh.
And you see all these beautiful things you can do.
Yes.
And you get so excited about being creative. And the reality is that that's very expensive and you're not going to make a big return on it. So those are really the two keys, I think, is to seek out the advice of the people that have your best interest in mind, not just theirs. Sure. Not that real estate agents are wonderful people, and there are wonderful, wonderful real estate agents. But again, like everything else, there has been such an influx in that industry that there are truly people that don't have the experience to be navigating through these transactions, and they don't care. So working with a good realtor with a good reputation is pretty key. And there are real estate agents that specialize, especially in investor properties, and they can kind of sniff out some stuff where you can get a little bit better deal. But buying at half of market, not going to happen. Buying at foreclosure sales, not going to happen. You can't compete.
Right.
So, but those are really the keys, I think.
Wonderful. Well, thank you so much for coming on my podcast. I really appreciate it.
Sure.
And to everyone that's out there listening, if you guys have any other questions or follow-up, please reach out to us. We'll put your contact information out there.
And I'm available to answer questions. And I do that a lot. I have no qualms about giving someone just some general advice. And to me, that's kind of my charge and my duty and my job, is that, I have knowledge about things, and that really is my responsibility to share that, because people work, especially entrepreneurs, they work very, very hard for what they have. And I do my very best to make sure it's never put at risk, undue risk, of course. So Yes, absolutely. Anytime. Shoot me an email, give me a call. I'm glad to answer questions.
Well, wonderful. Well, thank you. And I definitely recommend that anyone that is out there looking to purchase or acquire or even think about it, that they should seek the advice of a banker just to sit down and just to crunch the numbers. I mean, at least you have some idea of what you can afford to even buy. So you've been a wealth of knowledge. I really appreciate you coming on, and thank you everyone very much. And I hope you guys got a little bit something new out of this.